This version of the anti method is built using the stochastic oscillator. I call it the classic. This setup has become one of the most reliable ways to use the stochastic for trading swing setups, offering somewhat precise entries in the direction of a prevailing trend. One thing we need to learn that the anti-method is a trend continuation strategy designed to capitalize on pullbacks within a larger trend. The strategy is simple and combines two basic elements: trend continuation and momentum alignment. So let's have a quick recap of the stochastic oscillator itself and the settings that we will be using. This oscillator measures momentum by comparing a stock's closing price to its price range over a specific period. It's made up of two key lines, and maybe it's just me, but I find the naming of lines to be slightly confusing. But as I said, maybe it's just me. The primary element of this indicator is the K line, the faster line which reacts more quickly to price changes. This K line tracks the latest price in comparison to the price range of a selected recent period. The rate at which this K line moves basically measures momentum. Alongside our fast line, the K line, is the D line, the slower line. This works as a signal line, something that you find on many indicators. It is nothing but a moving average of the K line. Being an average, it is slightly slow in responding to the rapid shift of a single period. It therefore smooths out fluctuations and provides slightly clearer signal, and also indicates when the momentum has shifted. For our strategy today, we will not use the default settings. Instead, we will use custom settings on our oscillator, and I will explain why we are doing this. Okay, let's begin with the settings for the K line. The default setting for this that you'll find typically is set at 14. For our strategy today, we will use it as 7. This is a shorter time frame to capture quick momentum shifts. Reducing this setting makes our fast line even faster. Now let's move to the D line. The D line usually has a default setting of 3 period. Therefore, despite being slow, it is still quite sensitive to the movements in the K line. For our strategy, we want this line to be more stable as it is pivotal to our strategy in determining the underlying trend. So for the D line, the setting used in our strategy is 10 periods. Yes, we are increasing it from 3 periods to 10 periods. I think it is a true genius as it makes our slow line much more slower and therefore a better indicator for predicting trend. There is a third parameter used for defining the smoothing for the oscillator. However, not all tools have this feature. In case your tool has it, use this as 4. So what have we used? We have used 7 for K line, we have used 10 for D line, and we would be using 4 periods for smoothing. Let's take a pause here. So what have we done? Now, a lot of people confuse in these strategies is they think that this is a stochastic oscillator and I've modified the settings, and now the stochastic oscillator should work in a particular way. Well, theoretically, we are still using the stochastic oscillator, but we have made very fundamental shifts by this change in settings that we have done. While the K line remains the K line, is the D line still tracking the K line? Yes, it is. But it has basically shifted in the role it played. If in our mind we are still anchoring, this tool still behaves as the stochastic oscillator, in short, it does not. It is so far detached from the K line that it is now saying if the overall price is trending in a particular direction or not. Let's move to our strategy. As I mentioned, the bullish anti-setup is a trend continuation strategy, which means it looks for a pullback within an existing uptrend to time our entry into the trend. Once again, this strategy is not to find a trend reversal point, but to look for opportunities from a temporary pullback in an otherwise established trend. To do this effectively, we will follow a structured approach with 3 key phases. Phase 1 is to confirm the trend. This is to ensure that momentum is still intact. The second phase would be to spot the pullback and see at the setup, and finally execute the trade. Let's break this down into a step-by-step approach. Our first step: confirming the trend using the slow D line. The first rule of the anti-method is only taking trades in the direction of the existing trend. Unlike our common practice to identify trend using higher highs, higher lows, to confirm a trend in this setup, we will just look at the D line. This will act as our trend filter. Well, what are we looking for? The D line should have a clear upward slope. If the D line is sloping down or momentum is flattening out, the setup is invalid. And why is this important? The D line measures the trend of momentum. Since momentum often leads price, a rising D line tells us that despite short-term fluctuation, as long as the D line is trending upwards, the dominant force in the market is still bullish. Step 2 of our strategy is to spot the pullback using the fast K line. Now that we have confirmed a bullish trend using the D line, we wait for a pullback. During this phase, the K line, which is the fast line, will move sharply downwards, indicating a short-term correction in price. A key detail here, the D line must remain upward sloping or at least flatten slightly. If both the K line and D line start falling together, or if the K line falls but then the D line follows, the setup is no longer valid. Just exit your strategy here. This moment is critical because it creates a tension between the short-term weakness and the long-term strength. This imbalance is what eventually fuels our next step. Step 3 of our strategy. So far we had a D line which was sloping upwards, a K line which has just taken a short-term correction. Now we have to spot the hook on the K line. This is the actual entry trigger, and it comes when the K line stops falling and takes a hook turning its direction of the trend. This is where momentum aligns with the trend, a concept that Linda Raschke refers to as positive feedback, where short-term momentum catches up with the dominant long-term force. Ideally, the price should be holding a support level such as a prior swing low or a moving average. If a bullish candlestick pattern forms, this is a further validation that we can use. At this point, now we are ready to take action. Step 4 is entering the trade. There are two effective ways to enter once the K hook has formed. Breakout above the previous bar high or trend line breakout at an entry point. Both of these entries ensure that we don't jump in too early, wait for a price indication instead. Step 5 is placing the stop loss. Since this is a momentum based setup, once the trade is triggered, it should move in our favor relatively quickly. The stop loss should be placed just below the low of the entry bar or below a nearby support level. In swing trading, the market should not look back after confirming the setup. If price falls below the stop loss, it means momentum has failed, our analysis was wrong, let's accept it, and better to exit and wait for a better setup instead of continuing to lose money, because managing the trade is just as important. It's important to exit this strategy on the high, and that's where you can reduce the number of losses you'll make. Just wait for 4 periods. After the 4 periods, continue with a trailing stop loss, but don't take any risk. The strategy is really effective for 4 to 5 periods. Once you have crossed that point, better to take profit or work with trailing stop loss. One final thought. While the tool theoretically works for a bearish setup by reversing the entry and exit points, however, I have not been able to find results with this strategy. Just something to think about. After all, we are all just learning. If you found this video helpful, make sure to like and subscribe to the channel and drop a comment below so I can learn from it and incorporate your feedback in my future videos. Also share this with your friends so that we can expand our circle of learning.